Good evening, everyone. I hope you can hear me. Just double checking to make sure that you can. All right, I've got somebody's video up for some reason. Great. All of a sudden, my font size in my chat box is super, super tiny. I don't know what happened. That's usually a Java problem. But I have updated everything. There used to be something on here for the font size. So I will probably be very getting really close to the screen to be able to see what it is you type if you type anything. So I keep going. Let me get the application sharing started here. And tonight I'm not going to use the video just because I'm on a wireless as opposed to wired, and sometimes that really slows things down. Maybe I can try it. You guys can tell me how much this is loading or not loading. If you don't want to see that, just let me know. It's this laptop I'm on. The camera's down in the bottom right corner instead of the middle, so it looks a little odd. All right. And if it just loads slow, if it messes things up, let me know, and I will. All right. And we'll change things. Okay. All right. So I've got the PowerPoint up. Actually, tonight is this week's visit was to Phoenix, Arizona. I thought I was going to be there, but I'm actually back. But it's a pretty picture, so I left it on the deck. So there you go. Overall, the class is doing well. We have some people struggling sometimes with the technology piece a little bit still. We've been posting the videos of these lectures off of YouTube. So if you're having trouble, you can find them. It's still not as effective, I don't think, as the class live. Because frankly, in class live, I can check and see if you've actually done looking at the lecture. You send me a question about your homework, and well, I don't understand it. I can look at it. Did you even look at me explaining the homework? So it's helpful if you use class live, if at all possible, related to the course. But I think overall everybody's doing well, the discussion as well. I'm going to talk about the homework a little bit once again at the end of the lecture. And it is really just watching a TV show and then writing about it. But I want you to listen to what it is that I want you to write about these TV shows, and we'll go from there. So, pretty basic. But really tonight the discussion is the cost of capital. I'm going to spend a whole lot of time about the cost of capital and a few different situations. The interest rates will be a lecture that we'll have upcoming pretty soon. But right now, we're just going to talk about some real basics of capital and what is capital and where does it come from and what it kind of sort of does it cost and what it kind of sort of do you have to do to calculate the cost related to that. Now, the book does this great job here of this super hyper technical academic method of trying to describe to you the weighted average cost of capital. And all that really means is most people take capital in, which is the money to feed their business, right? The money that they need. Not everybody has a rich aunt that's going to give them money to feed their business, so they're going to go to the bank, they're going to borrow some money, they're going to take their profits, put it back into the business, they're going to take in a partner and say, hey, why don't you put some money in this business, you can be a part owner with me. It's loading very slow. Okay, I'm gonna undo the video. All right, and then that probably should help. The point being this is a great way to do it, but there are different kinds of capital and they have different cost structures. As you can imagine, if you loan money and you have collateral on that, if you loan money on a house and you're in the first position, if somebody doesn't make one house payment, you're able to take the house back from them. That's kind of got a different interest rate than if you were loaning money to somebody you've never met before who's got a marginal record and maybe something you never heard of, and they're going to go build a factory in Nigeria, wink, wink. You're obviously going to want a different kind of return on your capital. So there's different costs to different kinds of capital. So while the book does a great job of explaining it in traditional academic methods on how to determine the overall cost of capital, which means if you take all of the components of capital together and kind of average them all up, what's your cost of funds to do what you want to do? And I've talked to you before about return on invested capital, so people want to know are you getting a return on your total capital that's greater than the cost of your total capital. And I'm going to try and make it really, really, really simple by using, guess what? Excel. But let's talk about the sources of capital and where they can come from. And the sources of capital are really in two buckets. One is debt, and the other is equity, meaning debt, meaning you borrowed money from somebody. It can be as simple as your suppliers are giving you credit, like you get credit on your electric bill. Your suppliers are giving you credit. You could borrow money from a bank. You could borrow money on a credit card. You could issue a bond if you're big enough and a public company. You could issue a bond. But this is money that you owe somebody that has a stated interest rate on it that you will pay back in some specified and contractual way. Debt. The other way is equity, which means you're taking in partners. People have invested in your business. They put money into your business and bought a part of it. And that is called equity or ownership or stock or a share. And that's one way to get it, is people invest in your business. And the other is you make money and you leave it in the business. So you could make money and take it out and put it in your pocket and take a nice vacation, or you can make money and leave it in the business and grow the business. So those would be the two most basic forms, debt and equity. There are some stuff that's kind of in the middle. I've alluded to some of that in the past. But for our discussion this evening, what we're going to talk about is preferred stock. So it's stock, it's ownership. It represents a piece of the ownership of the business, but it has some preference. If you think back to one of the very first lectures we had, we talked about the hierarchy of preference, and we talked about preferred stock at that time. And so these people are ahead of the common equity holders, and oftentimes would be paid some sort of a stated almost interest rate, but probably paid in dividends from the company or paid out of the profits of the company to pay them for their investment. So what they are, the debt holders have a contractual right that they get paid a certain amount of money and they get paid back on a certain schedule according to a contract. The common equity holders are the owners of the business, and they get what's ever left over in the middle. The preferred stock is a pretty cool position because they're getting paid on a regular basis usually, like you would on debt, but they also can participate in the upside of the business if there is any upside in it. So if the company becomes much more valuable and you sell it at some time, you can get the profits from that too. So it's kind of a really, really good position to be in. It depends upon what your investment characteristics, horizons, needs, wants, desires are. It's certainly riskier than debt, but also has more of a greater return than debt. Not as risky as equity, but may not have as much of a upside. It just depends. And the thing is, preferred stock is structured so many different ways. I'm not going to spend a whole lot of time trying to tell you all the different permutations of preferred stock, but I just want you to understand that it's out there. So, how can you get capital? And if you just think about your business in terms of maturity, and you are starting a business or you have a business, where would you go to get capital? Where would you go to get money to fund what it is that you want to do? Back to whatever my latest example is, if you're trying to, get in the hamburger business, the cabinet making business, the landscape business, I don't know what business you're in, but it usually takes money to get going. In any of those cases that I just described to you, it would take money to get going. And I don't care if you are just, a consultant and you're just selling your services, or you're a musician. You've got to buy a guitar, you've got to buy an amplifier. If you're a consultant, you've got to have a telephone. You've got to have some money to fund this business. So in terms of how mature a business is. So if it's really, really, really starting out, right, at first you're probably funding it yourself, right? Back to any of those examples, you're probably doing it in your garage, in a spare bedroom, in a shared workspace. You might be starting it out of the local Starbucks, I don't know. But certainly most of this stuff is getting funded by yourself. It's coming out of your pocket. Kind of the next level would be your friends and family. You go to that ranchette, your mom spots you a little bit. Somehow you get to the point to where you can get a little capital in your business to take you to the next level. Not actually be the actual seed capital to get you started, but that's one. A very source of capital that most people don't think of, and I have actually seen this in practice, and it's really kind of crazy, is customers. And I'll be, yeah, customers. And so sometimes if you have a product or an offering so valuable, people are willing to pay for it, and you say, hey, I can't take your order right now because I just don't have the capital to go buy whatever I need it is to deliver my services to you. I have certainly seen customers write a check in advance as a deposit on you delivering whatever goods or services that you want to do to them. So yes, even as something like customers or your vendors, your suppliers, back to the cabinet making example, the people that are supplying the wood and the glue and the nails and the paint and the stain and the sanders and the sand, the sandpaper or whatever it is that you're doing to build a cabinet. Those people could be your funding source. They could be customers, vendors, that kind of thing. Kind of the next level up is you've got a concept, it's proven, it seems to have some potential legs. There's a thing out there that's called angel funding. And angel funding is typically high net worth individuals who had run successful businesses in the past, and they have a little money on the side that they like to invest. And it's usually people coming together as professional groups. People would come present to them, or it could just be somebody you know from your life, a friend of your parents, whatever it is. They would invest, it could be $25, $50, $100,000 in an angel funding round. And it's usually high net worth individuals who have true business experience and acumen that would decide whether they wanted to directly invest in your business. And venture capital is very structured, very institutional. It's professional money. They invest professionally in early startups. Usually, you would think of any high-tech startup that you can think of, and they would have typically gotten some sort of a venture capital round at some point in time. Dallas is full of venture capital funded deals, particularly on telecom. So Mavenir is one that comes to mind, but there's just scads and scads and scads of venture capital funded companies in our area. Probably the key, the center of the universe around venture capital would be San Francisco, Silicon Valley, and let me get rid of this. Thank you for all your information. And but these are, venture capital are people that would put in, there's no rules, there's no hard and fast rules here, but just kind of generally, sort of, they might put in $5 million and expect to get 40 to 60% of your business. I put it in with myself. I own it all. Maybe I've got my friends and family. I give them a little piece. They loan me some money. Angel funding, I'm only taking 25 or 100. And we'll talk about angel funding a little bit later in the program tonight. And then venture capital obviously is institutional, but you have a real company at this point. You have a real product that people think that they can accelerate and take to the next level. Kind of the next kind of capital funding, equity capital funding that you can get is private equity, and that is a huge range. There are people that will put in $5 million in private equity to an established business to help give it growth capital as opposed to seed capital or early stage capital like venture capital. Private equity is investing in something that's much more certain and much more proven, but somebody might put in $5 million and somebody might put in $5 billion. And it really is all over the map. So when I say it's a huge range, it's a huge range, but it's very professional money. It could be investing on behalf of endowments, the Harvard University Endowment Fund. It could be investing on behalf of the California Teachers Pension Plan, the Canadian Teachers Pension Plan, whatever. There are these huge investors that invest in these private equity funds, and people would make a portion or an allocation of their investment to put into companies directly through private equity, because the returns are typically higher there than they can get in the stock market. So they will allocate a portion of their investments there. So there's just this wide range of private equity funds, professional, very, very professional and institutional in nature. Then as you go up the food chain, there's also a food chain in the kinds of debt that you can get. So one of the things that you can do in a lot of early stage companies that don't have a lot of funding, they use something called factors. And these are independent businesses that loan you money by essentially loaning you against the receivables that you have generated. So if you make a sale but you haven't collected on that sale, because like I said, typically, you know, in business, you sell something to a company and they have a period of time in which to pay you back, and say it's 30 days. The factory would pay you right now for that invoice, so you would have money right now to operate, and then they would collect, you know, a month later, but they're going to charge you a whole lot of money to do it. But it's a totally legitimate kind of business. It's a great way for early stage businesses to get off the ground, establish credit, get funding for their businesses, because perhaps you've sold those cabinets that you made and you owe money to the wood supplier, but you're not going to get paid for, you know, the old wood money to the wood supplier now, because he gave you 30 days, and now you've got to collect. So, well, where's the money going to come from? So you sell your receivables off to a factor, and they give you the funding to keep your business running and create working capital. And they it's a riskier position for them, so they get paid more. Once you move up the food chain a little bit, and you can get to bank debt, it's pretty legitimate stuff where a very traditional regulated business would come in and do a very traditional underwriting of the risk of your business and loan you money, and they might charge you all over the map. But I've just got some wild examples here of, say, 3 to 9% interest rate on what it would cost you to be able to borrow money from a bank. And then if you get really, really big and say you're a public company, you could sell public debt, and where the debt itself is kind of traded just like a stock is traded. And so my company, for example, we would have some syndicated debt where that actually gets traded around a little bit, and really big companies would issue, say, a bond. And so, you know, there are hierarchies of what these different things mean, and what stage of company that this kind of capital would come in. So let's talk about this. Sources of capital is the percent of the equity raise or the rate. So how much these people will get a piece of your business if they give you funding? Well, if it's yourself, you get to keep the whole thing yourself. And most people would call that bootstrapping. And you try and hang on to your business as long as you can without taking in any more equity, because the sooner you take in the equity, the more expensive it is. And what that means is you have to give up a bigger percentage of your business for a smaller check size. The earlier stage, the less proven your business is. The more proven, the more established, the more your finance word of the week is traction. The more traction you have, the cheaper the money is to you. If it is yourself and you're able to bootstrap, you get to keep 100% of the equity. If your customers or vendors are funding you, you're almost never would give away any part of the equity of the business as a result of that. Maybe in a friends and family round, you know, I don't know. Like I said, there's no rules here. I'm just trying to give you a sense of it, that they might get 10 or 15 or 20% of the business by funding you, you know, because they're your friends and your family, and they're investing in it because they like you and they love you and they want to help you, but they need to get something back for the amount of money they invest in the business. And that's probably very common. It may not be fair to them based upon the stage of your business, but that would be something you would be looking to do. And I think everybody would be happy to see you succeed. Angel funding, when those entrepreneurs who run a business have some money to invest, and they're going to pay $50,000 in your business, and say 10 of them are going to put in $50,000 each, and you're going to raise $500,000 for your business. Nobody really knows what the business is worth at that stage, and so The actual how much they get would be convertible, so their debt would convert, and their ownership would convert to some percentage of your company based upon whatever the next round of funding you got was. And it just, all you need to know is it's typically not defined, and when they get their Series A, which means A, B, C, D, E, duh. So Series A, your first round of funding, there's your finance word of the week. Number 2 is when you get a round of funding, the first round is your Series A round, your next round is your Series B round, your next round is your Series C round, and that's how everybody knows how many times you've gone out and raised funding for your business. So they would convert at a discount of whatever you got from your first institutional round. The venture capital, like I said, they're typically looking to own 40 to 60% of your business. And private equity, once again, is a massively huge range, and they could own as small as 15% to 95% of their business. And in many cases, they just might buy the whole thing. But if you're an entrepreneur, you don't necessarily want to do that. And here's the beauty of debt: no equity. So if you can get good bank debt, it is almost always the cheapest form of capital, as long as you are actually creating value. If you have something that's in the tank and you're borrowing from a bank and they're just going to come take your business from you, it's not very, very cheap, is it? But to the point is that as long as you're creating value and growing your business, debt will be cheaper than equity. May not be as easy to get sometimes, may be harder to get. It really kind of depends on how well your business is doing. So why are we talking about this? What is the point? And the point is, you try to decide. You want to know how much capital is going to cost you, how much is going to come out of your pocket, because this stuff matters. It really matters to your business. So you've got to understand, if I'm going to take in capital, what does that cost me? Because I need to know if it's worth it to me to make the investment I want to make with it. Or frankly, if you don't want to do that, maybe you've got some excess cash, and so you've made profits. So you're trying to decide, am I going to leave that in the business and invest in the business for future growth, or am I just going to pay it out to the owners? You want to be able to understand the cost of the capital. So if somebody says, hey, I want to build, that new Dr. Pepper plant in Waco, and you've got to figure out how much does the capital cost you to do it, and then how much money are you going to make on that project to determine if it's something that's worth doing or not. You need to understand, it may sound odd, or maybe not necessarily intuitive, but businesses will change their behaviors based upon the capital structure. Businesses will change their behaviors based upon the capital structure. And it really depends, if you are loaded up with a bunch of debt and you have a bunch of covenants on it, and all you can do is just pay down the debt, that's what you'll do, and you won't invest in the future. But if you have a bunch of lenient investors that want you to grow, and they'll put capital in to grow, you will behave differently. So my point is the cost of this capital, what it takes and what the intended uses of it are, will matter. And they also would use the cost of capital to determine if you want to do a project or not, because it's kind of an internal benchmark. And then external forces will benchmark you against how much you earn on the money that gets invested in your company. So very interesting, but I think that when I say what's the point, there is the point. Well, a couple of little points to think about is most people just look at the cost of capital, but we're going to talk about the after-tax cost of capital in a little bit tonight. But it's just really, there is a difference between cost of capital and the after-tax cost of capital. Always remember that, after-tax cost of capital. It's back to this, here's your finance word of the week, number 3, is TCO, total cost of ownership. You want to understand what the whole thing is. So it's one thing to buy a car and have a payment. Well, you got to have the down payment. You got to what's the gas you have to buy? When do you have to buy wiper blades? When do you have to buy tires? What about the overhaul? What's it worth when you sell it? So what is the total cost of ownership? It's the same for capital. You want to understand the total cost of that capital, and the best way to look at it is on an after-tax basis. I'll give you some examples when we get to Excel a little later. Now, you're really trying to focus on what's the new capital. It's really what you're trying to analyze is that most of the time is what is this new capital going to cost me. But to understand what the existing capital structure for any business is if you can get into, if they're an audited environment, just read the financial statements. It's like we talked about when we talk about financial statements, you have to read the whole thing. You don't just read the numbers, but read the footnotes to really understand what the capital structure is, because it is in there. If you simply look at the numbers on accounting statements, it will not give you the complete picture. You have to read the entire financial statements. But if you do, you'll have a really good feel for what the cap stack, finance word of the week number 4 or 5, whatever it is, the cap stack or the capital structure of the business is. When you're doing this, you need to make sure that you are using market rates. Now, that doesn't mean so much today when rates really don't move around very much, but historically they have moved around a lot. So if you're using the rate that you used 3 years ago, it may not be the current rate. So you need to make sure you're using market rates. As you're trying to evaluate different projects, do I, build a Dr. Purple plant in Waco or Paris? Or Texarkana, you want to look at those separately. And then if you are going to do multiple projects, you want to evaluate them all together. And then if you have great projects, which ones should you do? My point here is that in a business, no matter what money you have, there will always be competition for something to do with that money. There will always be competition for something to do with that money. You may want to give the employees a pay raise. You may want to take the money out of the business and give it to the owners in the form of a dividend. You may want to build that Dr. Pepper plant in Texarkana. You may want to expand beyond Dr. Pepper and start manufacturing 7-Up. I don't know what it is, but there's always going to be competition for capital within the company. Somebody may want to buy a new, invest in a new software package. Somebody may want to get a new building. There's always a use for the money. And so in finance, it's our job to decide which ones are really worth doing, because you want to put your capital where you get the most return. Simple, right? So how you do that is one of the tenets, one of the fundamentals that we have to get established here before we get to the next level is what's the cost of that capital, so you can understand if it's worth doing. So there's some other things in here in the book that talk about some ways to do it. The capital asset pricing model, it helps you understand the cost of equity, because if it's debt, you know what it costs you because it's got a stated interest rate. If you've got preferred stock, you know what that costs because you kind of have the dividend on it. But what's the cost of the equity component? What is the cost of that? It's kind of hard to calculate. So there are some ways that finance tries to estimate or simulate what the cost of that capital is. One is the capital asset pricing model, which they talk about in the book. Discounted cash flow, which is the net present value calculation that we talked about last week, which is, what do you think the cash flows to this business are, and then discount that back, and then that's what the value of the business is. That's what the value of the equity value of the business, not the total enterprise, but the value of the equity. And then another way to do it is a bond yield plus risk premium. What that really means is if you said a typical bond in today's market pays, I'm making up a number, 5%. Well, if I was investing in the common equity of Coca-Cola or Walmart or ExxonMobil, that's not a very risky investment. So the premium that I would want to earn on my equity over what I could get on a bond is fairly narrow. But if I was going to invest in Shifting Sands Mutual Insurance Company, I might want a much higher premium. So whatever that market rate of a bond is times, multiply times 2, that might be what I want as the risk premium I would want in my mind to make it worth it for me to invest in a riskier business over taking a smaller yield in a very secure business, right? So and that's really they're just trying to find a way to estimate what the true cost of equity is. And until everything's over and everybody's gotten their money back from their investment, if they missed $100 and get $120 back, they made a 20% return. You don't really know until the end. The problem is in finance, we're trying to figure out in advance what we think that cost of equity is right now, but we don't really know. So what can influence a weighted average cost of capital? Market conditions, whatever our cap structure is, whatever our dividend policy is. So if our dividend policy is that we dividend out every dollar we make, that will affect how much we have to pay to get new capital in. If our policy is we leave all of the earnings in the business to invest in the business, then we would get a different result. So what do we invest in? And how much money can we make on those investments? If we're going to take 3% money and invest in something that would make 4% on, it's not very sexy. But if we take 5% money and invest in something that makes 15%, maybe that makes sense. So those are some of the things that we're trying to figure out when we talk about cost of capital. And then should the company use the composite weighted average cost of capital as a hurdle rate for each of its projects? And the answer is no, but it should be undertaken to think about it. What the weighted average cost of capital is the average cost of the total capital in the company. And however, some projects that you would do in a business could be riskier than others. If you build a Dr. Pepper plant in Waco to sell Dr. Pepper and Big Red in Waco, it's probably not very risky. But if you're going to build one, in Aruba where they've never heard of Dr. Pepper, it might be quite a bit more risky. And therefore, just because the return of that business potentially could exceed the weighted average cost of capital, it is only one of the things that you would consider as to whether that was worth doing or not. So the point is different projects have different risks. Now, there's a few other things before we move to Excel. You may read the chapters. There is a PowerPoint slide in doc sharing from the publisher that's got a lot more info that I think simplifies some stuff that I really didn't go over here tonight because I'm going to try and do it my way, not their way. But I've said it 50 times in the course. I'll say it another 50 times. Different people learn differently. I do not care how you learn. I just want you to learn. If you learn from reading a book, read a book. If you look, I think you ought to do it all, but you ought to emphasize where your strength is. If you do well, like I always did in school, was if I could have a professor that would just kind of explain it to me, hopefully the way I'm explaining it to you, hopefully I'm doing a good job. But if I can have a professor explain just some of the characteristics of the subject matter, always helped me. So I was much more of an auditory learner. Some people, the PowerPoints, they're kind of the summarized bullet points really help them. So I really don't care, but I think that that's good, something just flip through and understand the subject matter. Now, to the homework for this weekend, it's a little different in that we're going to watch the TV show Shark Tank. There's a bunch of very successful people on there locally. The people that everyone knows is Mark Cuban. People get on the TV show, and I'm sure everybody's seen it, but in case you have not, they present business concepts and trying to get these rich people to invest in their business. There's a lady on there that was I think she's one of the owners, founders, big shots at QVC, the TV sales engines. So there's some really interesting people. There's a guy on there that did FUBU fashion, so he's really got a great sense for what individuals like to buy. So it's the reason that we're doing this is it's very much like if I go back to my sources of capital, and I know this thing is loading slow, so I'm going to be careful about it. But if you come back here to where it says angel funding, that's really pretty much what this is. These are people who have money to invest in a business. They're high net worth individuals who've had a successful exit. They're sitting on investable cash. Finance word of the week number 7, exit, which means they sold their business. A successful exit means they built the business and sold it and made $1 gazillion. So angel funding is very much what's going on here on Shark Tank. So it's a TV show. These people will present their business, and then the shark will decide if they want to invest in it or not. So your homework this week is to watch Season 9, Episode 2. There's 4 or 5 different scenarios on there. Watch one, pick it, and write about it. And I want you to talk to me about which one you've chosen, and I want you to talk to me about the business deal. How much did they ask for? They wanted $200,000 for 20% of their business. What are they saying their entire business is worth? How did they get to that number? Did they have sales? Did they not have sales? Did the sharks like their cost of their goods as opposed to what they sold it for? Did they get the money? Should they? Do you think it was a good deal, bad deal? But I want you to talk about the deal points much more than, hey, they were selling really cool sandals and I like sandals and so I would do it because I think sandals are cool. Look, you're probably going to say that a little bit, but that's really not the point. The point is I want you to talk about the business deal, the business deal, the business deal, the business deal. But you can't talk about the business deal without talking about the concept. I get that. So talk about the concept, but let's talk about it and just keep it evolving, keep it moving. And I really want you to respond to somebody else's post at least twice. So respond once, respond twice, and you'll get full credit. So it sounds easy. I watch a TV show and write what I think. That's it. Watch TV show and write what you think, but you have to think about what you think because I want you to think about the deal, about the money, the business deal. Was it a good deal? Was it a bad deal? Would you have done that deal? If they didn't get the money, should they have gotten the money? Did they get it because they got greedy? Did they, they asked for too much and that's why they didn't get it? They got a lower offer. Perhaps they got a higher offer from somebody they didn't want to be in business with. I don't know, but those are the kinds of things that we want to talk about. And kind of the last element is we're going to move on to Excel now. If you give me just a second. And let me get that loaded up. All right. Can everybody see this simple little Excel spreadsheet, I hope? I hope it's loaded up for you to visualize now. And this is back to earlier in the talk this evening. I talked about you need to think about the after-tax cost of debt, the after-tax cost of debt. And I have two examples here, two columns. I have operating income of $100 million or $100,000, let's call it. Well, this in the no debt column, they didn't borrow any money, so they still had $100,000 in profit. But they had taxes of 35%, so they lost $35,000 of it, and their net income was $65,000 on the $100,000 they made because they had to pay $35,000 in taxes. Right? On the same example, on some debt, they have $100,000 in debt, but they had interest expense of I'm just making up numbers here of $20,000, so their profit was $80,000 as opposed to $100,000, but they had taxes on it. And for whatever reason, in the federal government's infinite wisdom, for many generations, they have allowed you to deduct from your taxable income the interest that you pay. So this would be your profit, would be your taxable income. At a 35% tax rate, that means you would pay, obviously, $7,000 less in taxes. You would make less net income, but your direct cost of debt was the $20,000, but the pickup that you made here on your tax bill was $7,000. So even though your direct cost of debt was $20,000, your true net total cost of debt was actually $13,000. Now, if your tax rate was lower, and this was 20%, it would have a very different number. So your indirect savings from debt would only be $4,000, and if it was 40%, your net indirect savings from debt would be $8,000. So if we use 35% as a standard corporate tax rate, that gives you a sense of what that could look like. So once again, there is a difference between no debt and some debt as to what the real cost of the capital is. So in this case, the real cost of the debt was not the $20,000, but it was truly the $13 because of the after-tax effects. Now, some things to think about is the interest deductions. Interest is deductible. So if you borrow money from a bank, Once again, the federal government and their infinite wisdom for generations have had these policies, which is if you borrow money from a bank, you can deduct the interest as an expense on your tax return. If you as a business pay your profits out to a preferred equity holder, you cannot deduct that. There's not a lot of difference, but it is a legal distinction so that if you're paying interest on a debt instrument, it is deductible for taxes. If you're paying dividends to an equity holder, it is not deductible. Hence, again, debt is cheaper than equity. You need to consider the total cost of debt because you may have an interest rate, but you also may have, to get the debt, you may have some origination fees. At the end, you may have some wrap-up fees. If it's a lease on a car, you may have some turn-in costs. You may have prepayment penalties. So that if you may borrow some money, think about this, if you borrow money from the bank, many times they want to make certain, absolutely certain you pay them back. But if you pay them back too soon, they don't want it back, so I'm going to penalize you, I'm going to give you a prepayment penalty if you pay me back too soon. So you need to take it with your origination fees. And many times, while you have interest costs, you may have an administration fee, an inspection fee, all kinds of things that they would undergo that would be involved in having that debt. So you need to understand the total cost of debt. And then you need to understand how you're going to use the debt. You don't borrow money just to borrow money. Borrowing money usually for a reason because it costs you money. Why would you borrow it if it doesn't have money? Don't have an actual use for it. And then, I think, once again, I think that's been evident through my discussions tonight, that if you are going to have a project, if you're going to build that new cabinet making shop, how much money you expect to make on it. If you're going to add a third shift, I don't know what it is, but whatever the proceeds from that project are, you need to evaluate those proceeds as opposed to what it costs you to get the capital to do it. And then you could also use weighted average cost of capital to do project evaluation. There's also something that, to me, I think is extremely important, which is the opportunity cost of capital. It's non-quantifiable, really. But what that means is if I had $100,000 of available capital and I used it for my new cabinet shop to be built, in McKinney, means I also can't use that. If that's all the capital I had, I couldn't also use that money to add a third shift to my existing business. So you have to make sure that you're making very wise decisions, and it's the finance department's job to make sure we're making wise financial decisions here with the investable money. And therefore, if you invest it incorrectly, you've lost the opportunity to invest that something in something that could have been better. So there's this opportunity cost of capital. Now the next thing is, I told you I would make the weighted average cost of capital simple. If you remember that formula I had on one of the very first slides that the book likes, let me tell you how I do it. It's much more basic. So what I have here are, in this column B, I've got the components of your capital structure. You've got some debt, some preferred stock, and some common stock. Your total capital in your company is $1 million in this example. 600 of that capital is from debt, 100,000 of that capital is from preferred stock, and 300,000 of that capital is from common stock. Well, so therefore we know that debt is 60% of your capital stack, your capital structure. 10% is a preferred stock, and 30% is your common stock. With me so far? Thought so. Now your debt, we've calculated you've got to pay 8% on that. We've also done the preferred stock, and we realized we've done a calculation on that, and we're going to have to pay a preferred return on that of, say, 8%, but then they get an equity kicker because it's preferred stock, and the real cost of that capital is 12%. And we've run bond plus risk premium calc, or use the capital asset pricing model, or use the discount cash flow analysis to determine the cost of common stock, and I've pegged that at 16%. So just representative, the cost of debt is 8, the cost of preferred is 12, the cost of common is 16. Well, because of the after-tax cost rate, I just used 30% tax rate in here. You can see where I use 70%. So say the after-tax cost of capital is at 5.6, but these are 12 and 16 because they're non-deductible. There's no tax deduction available to that. I merely took this number. I took 60% of my capital times 5.6%. In this case, I took 10% of my capital times 12%, and then I took 30% of my capital times 16% to get to these numbers. And therefore, a simple sum of those numbers is my weighted average cost of capital is 9.36%. I don't know about you guys. If I'm wrong, tell me. But to me, that's so much simpler than those formulas that are in the book. This is the way my brain works. This makes sense to me. Anybody have any questions on that? Because I think it's really kind of simple. And if you need to calculate weighted average cost of capital, I would just do this. It's just me. So what's the point? We talked about this before. We're trying to decide what's the right thing to do with our business, what's the best thing to do with the money in our business. And Hector said, straightforward, thanks. So, what's the point? Is we just wanted to decide what to do with the money. Should we invest it in something? Should we pay it out to the owners? We wait that we get to the weighted average cost because we get capital in different ways. We want to evaluate projects. We want to think about multiple projects in multiple ways, and we always think about the impact of funding to what it does to the owners of the company, because in the finance department, it is our yeah, Christy, if they're not out there, they will be. I think they're already in doc sharing. But if they're not out there, I'll go check and make sure they're out. But yes, they should be there. And so very important, you've got to think about this, is what it costs the owners of the business when you take in capital. What does it do to them? As the stewards of the company's finances, you have a fiduciary responsibility to do what's right for the shareholders. And so you're always thinking about this capital stuff as it relates to the shareholders. You always think about riskiness of the projects, and then you think about the investor's view and the company's view, and is it worth it to the investor and is it worth it to the company? And as it relates to getting capital in the company. We're going to get into this deeper later in other lectures and other weeks. We'll talk about interest rates and risk. But this was kind of step one in talking about it. And let me see if anybody has any questions. If not, we could be done for the evening. How's it calculated on the spreadsheet, the after-tax cost? Let me show you. We'll go back to that one. So this after-tax cost of capital is, I had the same income at 100. This one had no interest, so it was 100,000. I put the taxes on it, so the profit here was $65,000. I take the same $100,000 in income produced by the business, but I had some debt on it, so 100 minus 20 is 80. All right? So that's how much profit I have on the business because I had to pay the interest on it. But I'm taxed on this at this rate. So 80 times 35% is $28,000, which means 80 minus 28 equals 52. So that's my net income is $52,000, where when I didn't have to borrow any money, my net income was $65,000. But the cost of this was not truly the direct cost of debt, because I've got a $7,000 tax benefit here by borrowing the money, so my true net after-tax cost of debt was $13,000, not the $20,000. And you can just click on these and it'll show you all the formulas. However, I got to any specific number. It's done. I tried to make it very, very simple and in round numbers so you could understand it. You have 30 to 16 on the other table. Yeah. What I did was I just made up numbers here. Here we see. So yeah, 5% after tax. Yeah, that's where I'm going. So what I did here was I just took 8% times 0.7, which is assuming a 30% tax rate. If I was using 35, I would just say 6.5 here. So that's what my real tax rate is. That's how I got to it. So this cost was just 8% times 0.65. This is just weighted by how much of my capital structure is in that. So this is merely my weighted after-tax rate times the 60%. Now, if I said that this was 500 and this was 200, changes things some. You know, because I just put numbers in there for example's sake. I just made them up. Really no science to what's in there. I just use it so I could get to around a million. So 500,000 was 50%, and 200,000 was 20%, so you could see it. These rates here in column E, I merely made those up just because I thought it was, you know, 8, 4, 4. It looked kind of symmetrical and kind of easy to understand. That's the only reason those numbers are in there. Okay, awesome. Anything else, let us know. Keep emailing us, and be sure and copy Bo, because she gets back to you faster than I do. By the way, particularly on your grades and your homework and your quizzes, she's just going to be so much faster to get back to you. So thanks a lot, everybody, and have a great week.